Come on in, sit back and relax. You're listening to episode 272 of the WealthTech Today podcast. I'm your host, Craig Iskowitz, founder of Ezra Group Consulting. And this podcast features interviews, news, and analysis on the trends and best practices all around wealth management technology. My guest for this episode was none other than Jason Wenk, founder and CEO of Altruist. Now, give a little background on Jason. I pulled this from his website, jasonwenk.com. Jason is husband, father, fintech executive, writer, math geek, and investment systems developer. As I said, he's the founder and CEO of Altruist, a modern custodian for independent financial advisors. He spent the past 20 years working to make financial advice better, more affordable, and accessible to everyone. It all started when he took a job at Morgan Stanley in New York City when he was just 20 years old, working on investment research and asset management systems development. His understanding is that he was the youngest professional employee globally back then at Morgan Stanley. He studied computer science, which is something we both have in common, and he always viewed himself as a hacker, largely a self-taught engineer. So the financial industry fascinated him as there were many problems to solve. In 2004, he started his first company, Retirement Wealth Advisors. He noticed we had a rapidly aging population and a massive need for better wealth management. Along with a small team, he built software applications that would automatically help with key retirement decisions, mostly around income planning. The company took off, quickly reaching $100 million of client AUM, making him one of the youngest founders in the industry to build a firm that size from scratch. The success of Retirement Wealth inspired Jason to take his web-based software and make it available to other independent financial advisors, so his second company, Formula Folios, was born. Formula Folios would go on to become the fastest growing RIA in the history of the industry, organically growing from zero to nearly $4 billion of AUM in just 6 years. It also ranked as the fastest growing private company by Inc. magazine 4 years in a row, reaching, one of the fastest growing private companies by Inc. magazine 4 years in a row, reaching as high as number 10 in 2017. He won a number of awards, including being named Ernst & Young's Entrepreneur of the Year in 2018. Jason is also a prolific speaker and mentor to financial advisors across the country. Now, what did we talk about? A couple things. One, we talked about Altruist's growth, and we talked about some of the anniversaries they've had. This hit their 6-year anniversary, so we talked a bit about that, a flood of new entrants coming in. Then we jumped right into the meat of the discussion about Robinhood and TradePMR. Jason had a lot to say about that. And then he shared some of the up-and-coming features and services in their 2025 roadmap. But before we get to that, a couple of housekeeping chores. Please subscribe to this program wherever you listen to podcasts so you don't miss an episode. Also, check out our sponsor, the Invest in Others Charitable Foundation at investinothers.org. Now, let's kick this thing off. All right, here we go with our next guest. I'm proud to introduce Jason Wenk, founder and CEO of Altruist. Jason, welcome to the program, man.
Thank you, Craig. I one of your loyal listeners and readers. I actually really appreciate that you do the written summaries because there's days where I can just read faster than I can listen. And so I think I've digested almost every episode that you've done. It's a lot of them.
It is a lot. I think this will be episode 270.
Wow.
Or 271.
Congrats.
So we're up there. Yeah, thanks, man. Where are you calling in from?
So usually I work from our office in Los Angeles. Today I happen to just kind of have one of these unusual days where I'm starting the day from home and then heading in midday. But yeah, Altruist headquarters is in Culver City, which is a little kind of subset of Los Angeles, California.
Yeah, I'm just saying that because I'm jealous of your background, seeing the beautiful sky and green trees. Because I'm looking out of my window and it's like a frozen tundra here in New Jersey.
If it freezes here in Los Angeles, we've all got a lot of problems in America.
Exactly. Yeah, we won't go down that road, but let's go down a different road. For anybody who's living under a rock, can you give a 30-second elevator pitch for Altruist?
Yeah, so Altruist is an RIA custodian, so we exclusively serve registered investment advisors and their clients. We're unique in that we're a vertically integrated platform. So we combine the core clearing infrastructure of a custodian with really elegant software built with a collection of 100 plus microservices. So we kind of include everything from lightning fast digital account opening to fractional model-based trading and rebalancing, automatic tax management, fee billing, performance reporting, and then an open API to integrate with dozens upon dozens of third parties that advisors like to use in their businesses.
And I'm going to tell everyone that you just told me that today is your 6 year anniversary. Congrats.
Yeah, there's a lot of Slack chatter this morning. I should say, legally the company was incorporated in 2018, but I spent those first couple months just hiring people, and the first people, our chief product officer, today our COO and original CCO, their first days were Jan 7,
Mhm.
2019.
There
The
you
first
go.
lines of code were probably written, 2 weeks, from this date 6 years ago.
Yeah, and it's not as though business or technology is slowing down since then. So we're seeing more and more technology vendors, providers launching as technology gets more robust and cheaper and easier to deploy.
Yeah, I mean, I'm no stranger, nor are you, to the fintech solutions map, but I know you've done a lot of work on that with Michael. We were kind of reminiscing pre-recording that we've both been doing this for multiple decades, and it's pretty wild to think like how few companies there were 20 years ago, and today, I mean, it's hundreds and hundreds. There's so many solutions, and I think that it's interesting because, I think some people kind of they poke fun at the fact that, oh, there's all these, hundreds and hundreds of solutions, and maybe some of them aren't all that great. But the reality is like you just don't know when they start. Like it's almost impossible to know day one what will become amazing and great and highly, valuable to advisors and what maybe won't. And so if we're not, again, a flood of, kind of entrants and people trying to innovate, you're not going to have the handful that actually become really massive success stories that also end up, providing massive value to the market. So I'm a big advocate. Go out there, start great companies. You never know what it might become.
You heard it here first, folks. Get out there, start companies. Well, speaking of a flood of new entrants, let's talk about a new entrant in the custodial space. There was a story that came out of an acquisition of TradePMR being acquired by Robinhood, and you had a little bit to say about that. So why don't you just tell me how you feel about that, and have your thoughts changed in a month since you made that LinkedIn post about the whole deal?
Yeah, so I will say so I know Vlad well from Robinhood, and he's an exceptional product leader. Their team is insanely good. I mean, I will say, like, if you think about the best tech products that advisors have had access to in the last 20 plus years, I'm not convinced that most people who've worked at those companies could even get an interview at Robinhood. Like the level of talent there is very high. They're really good. This is going to make the whole industry better, right? So that I think is the case. Rob, I have tremendous respect for. I've gotten to know him pretty well. I remember the first time I met Rob. Actually, we talked a little bit about like what keeps him going and why does he keep pushing? And it's like there's all this consolidation, and he's gotten offers, I'm sure, over the years to sell. And he made this one comment which I thought was pretty cool. He said, I've made a promise to my customers, the advisors that we serve, that I will keep working until there comes a day that I think there's um, a company that can be a steward, like that can be a better steward than I can be for the future of this business. And he kept him independent for a long time, and he was a real innovator. I mean, he started TradePMR, I believe, in the 90s, before RIA custody was something that anyone cared about. There were no VCs that were, coming after this market. There was no private equity firms doing roll-up deals, not meaningfully like there is today. The total size of the space was maybe when he started, it was probably under a half $500 billion of total RIA assets. Like today, it's probably in the neighborhood of 10 trillion. So I think for someone to kind of have been, very early to innovate in this space, to stick with it for 25 years, yeah, I think kudos to he and his team. Like that's pretty awesome. So, I hope when people hear me talk about it, there's zero shade or disrespect. I think these are awesome people. Couldn't be happier for Rob to have like a great exit and for his team, and I think that Robinhood's going to be unlike anything this industry has ever seen in terms of like the speed and pace at which they will innovate. And so I think that's great, right? Like it doesn't scare me one bit. Like I view Altruis as like I'd say historically I was maybe sometimes bashful, sometimes outspoken about it, but I always felt like we were similar in that vein where it's like we were trying to build a real sort of Silicon Valley quality engineering led organization that really thought deeply about product and user experience and architecture and like things that maybe weren't happening at most advisor tech, kind of companies. So that's my kind of preamble. I'd say in terms of the deal, like there's a whole bunch, that I think we could go down and chat about. But some of the nuance that I think is critical if anyone's kind of looking at this and wondering, well, what's this mean? You know, Largely doesn't mean much for a couple of years, just because the deal's still not officially closed. It'll close sometime first half of this year, maybe end of Q1 or something like that, just pending regulatory approval. Until that deal is done, there's no Robinhood engineers like over there, like, rebuilding the TradePMR platform, right? Like they're going to wait until the deal's closed and then they'll start really kind of, thinking about like what's the future. After close, there's a lot of nuance that again, we happen to know a lot about because our journey was we started as an introducing broker dealer, and we cleared through Apex Clearing. And we eventually built our own clearing platform. We acquired an introducing broker dealer called SSG, and so Shareholder Service Group, and then we converted all of their clients, the vast majority, from Pershing, who they were using as their clearing and custody partner, to Altruis Clearing just a few months ago. So we've done this exercise, both like as the company's built the self-clearing from scratch, who's been the acquirer, who's moved people off, and that's the journey that they have in front of them. Is that TradePMR is not an actual custodian; they're a broker dealer, and they sit on top of Wells Fargo's First Clearing platform. So all the accounts are actually at First Clearing. All the infrastructure, the back office, all of that stuff is at Wells Fargo. And so what'll have to happen is at some point, Robin will have to build out all of those clearing and custody capabilities, which they don't have today. Like they don't have trust accounts. They don't have there's like a dozen different types of joint accounts because of all the different state requirements. They don't support fixed income, treasuries, CDs, alternative investments. They have no integrations with any of the dozens of platforms. So they will build all that stuff. Like so long as they want to, they have the capabilities to build it, and it's gonna be great. But people have to kind of keep in mind that it will cost a lot of money and time and R&D effort and all that stuff to build it. So that could be a couple years, maybe it's even longer. It's not inconceivable that it could be 3 or 4 years before they really are super robust in their RIA custody division. And so that's kind of the journey in front of them. So that for the next few years, a lot of things don't change much. If you're a TradePMR customer, you're probably using TradePMR's platform as it is. You're sitting on top of Wells, and your kind of business as usual until the day comes that you get a notice from TradePMR / Robinhood, whatever they rebrand it as, and it will say, hey, we've worked with DTC, we've worked with FINRA, we've worked with Wells, and we've come up with a deconversion date. Here's the date. It's going to be some point in the future, and the advisors will have to have some choices: do nothing, convert the assets over, move before the conversion date, but there's never an option to stay behind. When you do a deconversion, it's a one-shot deal, right? So any of those advisors that were at TD Ameritrade, they all saw this too. There was no option like stay on the old TD platform. It was like you're going to Schwab or you're going somewhere else. Like that's the options, right? So this is kind of like this is how this will play out like over the next few years, and it's just a matter of, again, I think the biggest unknown is the motivation at Robinhood to go fast, because the economics of serving advisors are very different than the economics of consumers. You look at their business today, they have less than $200 billion of assets, and yet they're driving $2.5 billion of revenue, right? So they're generating, let's call it 1.25% of revenue per dollar on platform. The Wells business is probably closer to 20 basis points, I would guess, high teens to low 20s. But if you took that and you converted it onto Robinhood's pricing schema, couple weird things happen. Robinhood pays such a huge amount on cash. They basically give all the net interest income away because their retail traders trade options and use margin and crypto and all these old things that drive a lot of revenue. Those advisors at TradePMR are not going to do that, right? Like they're not going to have like 30% of their client portfolios in cash and crypto and trading options and massive, margin books. Like they're going to be more normal ETFs, low cash positions, modest amount of trading, et cetera. So like the revenue would very, very well could end up being like 10 to 15 basis points, like very, very meager.
Mm.
So you have to kind of look at that and go, do we invest a few $100 million to build all that infrastructure, this whole big conversion, and do it lightning fast for what won't be a huge boost in revenue, right? Like TradePMR, they reported in the deal about 40 billion in assets. Doesn't take a rocket scientist. If you're earning 15 basis points, that's 60 million in revenue, 20, that's 80 million in revenue. All the assets will not stay there. I like just like all the assets didn't stay at TD and go to Schwab, and just like even in our case, not all of the Pershing assets moved to Altra. Some advisors chose to go elsewhere. So there'll always be some that will depart, and they'll just have to do that calculus, right? Like the exercise will be like, we could run really hard, invest hundreds of millions, and we could generate, effectively another 10, 20, $30 million of revenue beyond what that business already generates. Or is it like harder for them to allocate that money because they're like, our core business, which grew last year by 40+%, is generating 120 basis points with massive kind of operating margins, right? So these are just kind of like interesting questions, and again, only Vlad and his team know the answers to these. I only can speculate, but yeah, it's a really fascinating time in the space. Because yeah, we've got this entirely new, pretty exciting consumer brand, with great technology kind of coming in. But I think people have to be patient to see how it plays out. It's going to be a few years.
If Vlad is as an exceptional product leader as you say, and their tech team is as insanely good as you say, wouldn't you be a little bit scared?
No, I think like uh, so there's a few things at work here. I mean, should all companies always have some level of healthy paranoia? Of course, like I mean that should be the case with everyone. But I think that what you find is that there will be some people. In fact, I'd say a lot. You may have seen I did a little poll on LinkedIn. How many advisors would be excited about moving their clients over? And it was like, I mean, lots of people voted. Obviously, when you're the person who runs the poll, you get to see who voted and how they voted. There was like two or three advisors that said yes, and I mean hundreds, multiple hundreds that said no.
Mm.
Including because I can see the people were including TradePMR customers, right? They were saying no, I don't want to go there. So I say that to say like you can build a great product, but there's a few problems that Robin is going to run into. Like one is the brand is just not highly regarded with advisors. Like they don't think super highly of it. Um, how they've optimized their economics won't work for advisors. Like you can't have the industry's worst execution and maximize payment for order flow and have advisors who are fiduciaries who have a legal responsibility to disclose that they're actually looking at, trade quality and accept that. So they're gonna have to like really rethink a lot of things about that business. So I think that there's plenty of room. I think where they're going to push everyone is to build really, really delightful UI and UX. Like they'll be right up there with us in terms of the standard of quality, in terms of design, kind of the mobile first and kind of web first, like digital like native kind of processing. They're going to be very good. But in the end, I mean, I feel pretty about where we are today, and I know what our roadmap looks like for the next year, 2 years, 3 years. Like by the time they get to market, they will have a very formidable competitor, and we're a lot larger than TradePMR, right? So like we're, like by then we'll be presumably 2, 3, 4 times larger than they are. I don't know, 5 times larger than they are. So they'll be playing catch up, but they'll have a great product. And I think in a lot of ways, this does remind me of like TD Ameritrade back in the day. Again, we've been around long enough to remember like
Mm.
TD was actually TD Waterhouse and Ameritrade was Ameritrade, and Schwab and Fidelity were way out in front of them. And TD kind of came to the market, obviously combined I think the tech kind of infrastructure of an Ameritrade, or at least their way of thinking of building great product with, sort of the, trusted brand of TD, and became TD Ameritrade. And they really pushed innovation. It made the entire industry better. Had it been had not been for TD Ameritrade, a lot of tech companies that advise you today maybe wouldn't exist because there never would have been a Veo, there never would have been like an API kind of first infrastructure platform. So these things are not good. Like if you bring in new competition, it's just going to make it better. And I think the size of market is sort of like ridiculously big. Like so keep in mind, like 10 trillion in assets today. Let's just say the market doubles every 5 years, which is roughly what it does, 14%, kind of CAGR.
Mm.
And the real number is like 13, but like we're splitting hairs here, right? So by 5 years out from now, when Robinhood's like maybe a real legit competitor, really pushing hard, you're talking about a $20 trillion market. Um, if you're a trillion or two in that market, like you're a massive business. And so I kind of look at the whole world and go, let's bring every amazing company we can to this RIA channel. Uh, as a result, it will make RIAs better. And the real loser in this is going to be like independent broker dealers that nobody's going down to work for because they're going to be sitting on top of crappy old, technology infrastructure. If you're a wirehouse, regional bank, et cetera, and it's like you're trying to compete with RIAs. If RIAs have like this obvious consumer advantage being fiduciaries and they have incredibly good technology, we'll just see more and more of the, kind of inertia come here. And this will be a place where you can have, Robin can be hugely successful, Schwab can be hugely successful, we can be like everyone will be able to be as long as you're adding tons of value, right? So if we plan on adding tons of value, I'm sure they're going to try to add some value. There'll be lots of assets to go around.
All boats will rise.
Yeah, totally.
Do you still think your prediction that 40% of TradePMR clients will not want to convert to Robinhood when the time comes?
Yeah, I would guess somewhere between like maybe 10 and 30% is probably the right number. And that's okay. Like they shouldn't take offense to that. Like it's easy to take offense when someone makes a comment. I'm just saying that like I can tell you that, north of 10% of SSG advisors didn't want to come to Altruist, and that's totally
Mm.
fine. A lot of times their reasons are simple. It'd be like, hey, I'm 67 years old, planning on selling my business, and I don't want to have to go through this whole new technological thing because obviously we're a very tech forward firm. Robin is going to be a very tech forward firm. If you have advisors that are older, their clients are older, they're used to using paper, they're looking to sell and retire, like why are they going to make the change, right? So again, our number was very low. I'd say a little bit north of 10%, but not much. But there's always some attrition, especially again when it's like an older custodial platform and you're moving on to like a super modern, very digital first kind of platform. So there'll be some loss there. I mean, obviously there's a chance that they also grow a little bit, but I think at this point, it'd be really strange. I guess I don't know, but I can only imagine like if you're an advisor, why would you sign up for TradePMR today if you know you're going to have to convert all your business to Robinhood at some point in the next couple of years? And I think we saw SSG had that same issue. Like once we bought them, new advisor signups just slowed down a lot. So their growth rate kind of tempered. And meanwhile ours was, kind of hockey sticking. And so in the end, it was fine because we were running a dual custody platform. They have just the one RIA custody platform. So again, hard to say, but you have market growth, the natural kind of tailwinds from the firms already there. I'm sure they'll do fine, right? But there'll be plenty of people who just at minimum out of curiosity will look at other solutions, and some will move. The majority, though, will stay.
When talking about starting great wealth management companies, you're going to need software. That includes CRM, portfolio management, investment analytics, proposal generation, and reporting, to just name a few. And one thing all these applications have in common is data. And it needs to be organized, stored, and managed so you can leverage it across your business. Otherwise, you're just wasting a lot of time and money. Now, here at Ezra Group, when we start working with an RIA or broker dealer, one of the first things we do is a comprehensive data assessment. This provides a top to bottom view of all the incoming data feeds and which downstream systems depend on them for successful processing and reporting. This data assessment is a critical part of any firm's growth plan, since it is the foundation of building or improving the firm's data warehouse solutions. If you want to see your firm's data turned into an asset instead of remaining a liability, you need to run, not walk, to our website, EzraGroup.com, and click the golden Contact Us button on the homepage. The experienced team at Ezra Group will conduct a detailed data assessment deliver targeted recommendations to optimize your existing data warehouse systems, or even put together a new cloud-based solution to help take your firm to the next level. You can schedule a free consultation by going to ezragroup.com. So it's based on industry experience.
Well, I mean, if you look at all the deals before, because like there's been a ton of consolidation for custodians. At least what my understanding is something like 95% of the assets converted from TD to Schwab, right? So now that's a little bit different animal because like Schwab was already a big player in the RIA space, and so somewhat obvious that it would be that way. If you look before when like TD took Ameritrade advisors, took Scott Trade advisors, that rolled them like again almost 100% retention in those two deals. Even deals like Axos buying the E-Trade advisor business, which was kind of like marginalized by Morgan Stanley. Some people left, but a large portion still stayed there as the core of the Axos business today. So history would say some large percentage will stay there. The one thing that's just so unusual and kind of spicy about Robinhood is like they're just different than every other one of those other deals that we've ever done because they have such unique profile. Like just like the meme stock craze, like
Unique
the
client,
consumer
unique
behavior, the
customer
movie
profile.
dumb money, like a lot going on there that we've never seen with any of these other deals.
Right. A unique customer profile, different
Totally,
than
yeah.
RIA customers.
And even the way that they kind of monetize those customers. I probably do more work than I should studying every other company in the space. But if you look at the net flows, you can do some rough calculations on like how well our investors doing, just by looking at what are the net deposits relative to assets, and they report every month, and you can kind of go back and look at that. And you can see time periods where it's like, had all those customers just put their money into an S&P 500 index fund, there'd be like 20 or 30 billion more dollars of value creation, but instead they launch, election betting, like 5 days before the election, which will just help most people incinerate their money. Like these are just different profiles of people, of customers. And then the way that you build for them is quite different. An RIA platform, you should be absolutely hell-bent on delivering value to the customer. Like, I mean, the flywheel should be all about how much value can we provide to the RIA and to their clients. It should never be what kind of cool stuff could we do to get people to trade more often and generate more revenue. Like that
Of
just will
course.
never scale with
Right.
RIAs.
Well, one similarity between Altruist and Robinhood is you both started out on Apex.
Yeah.
Right. So you started
Big
out
shout out
there.
to Bill Capuzzi and team.
Right.
I think most meaningful fintechs started there, right? Betterment started there, still there actually. So I think who else was there? The Chicago-based trading app, blanking on their name, but you could go through a list of like, let's call it like the 10 biggest, kind of fintech, trading applications, robo applications in the last 15 years. They all started on Apex. So big shout out to them. Again, had not been for them, who knows? Robinhood might not exist. This trade, a lot of us wouldn't exist.
So what was the secret of your fast growth when TradePMR got into the business 20 years before you? Yet in that time, they only managed to grow to 40 billion in assets, where you were only around for 5 years and are much bigger than they are. So, what do you think the difference is in terms of scaling and growth as a custodian that's not one of the big three?
Well, I think so our path, I mean, largely comes from like that I started as an advisor. So my path is kind of simple, but engineer turned advisor turned fintech founder, kind of the short version. And in my time running advisory firms, it's actually I give a lot of props to Robinhood because they were really like the hair that broke the camel's back for me. I was running my last firm, and uh, we were maybe 4 billion or so in assets, growing really, really quickly, 100 plus million a month. It was all organic, no M&A, just a really rock solid kind of RIA platform business. And I was watching Robinhood launch, and 18-year-old kids could open an account and buy a fractional share of like Google in 30 seconds. And if we wanted to open an account, multi-million dollar account for a client, At best, it was using DocuSign that had to be sent off to a home office, and you wait, weeks for the account to be funded, and the NIGO rate would be 10, 12, 14%, whatever it might have been.
Mhm.
And it dawned on me, I'm like, this is insane that like the infrastructure that advisors have to use is laughable compared to how elegant and delightful the user experience is for consumers. And we did an integration with Apex at my last company, and it was a good learning experience. But what I found was that the sorry, again, hard to not see myself, but what I found was that the features that you needed to run a meaningful RIA at that time were just missing on Apex. Like they didn't have solo 401ks. There's a lot of other account types missing, security types that weren't supported, integrations that weren't supported. And so I would kind of look at the world and it's like, gosh, like there's no real way to build from scratch like a really elegant Robinhood-like, but for advisors platform. And keep in mind back then too, custodians were still charging commissions, which I knew was a total smoke and mirrors exercise. Like it was 6% of Schwab's revenue, but it was a way for people to not question how they really made their money
Mm.
through net interest income, order flow, fully paid lending, and all these other ways, right? 12B1s and so forth. So, for me, it was like first principles. I'm an advisor. I'm not happy with the status quo. If I was going to build this from scratch, how would I do it? Right. And so that's really where Alteryx was born. And, I think that because of that, our reception from advisors was high because I wasn't the only one who clearly had those misgivings. Like I was frustrated, and clearly lots of other folks were frustrated too. So when we kind of came out, our, you know, yeah, like launch strategy was pretty straightforward. It was industry's pretty broken. You shouldn't be paying commissions. You shouldn't have to trade in whole shares. You shouldn't have to use paper. So we're building a platform to get rid of all of this friction and like make it much more usable and fun and economical and drive down the costs and barriers for entry. And that really struck, a nerve within the RA community. And we very quickly had thousands of advisors on our wait list representing multiple tens of billions of dollars that will kind of raise their hands saying, we are also sick of the status quo. So that really helped us. We, built the introducing broker dealer on top of Apex so we could kind of prove this out. Like, let's launch, get to market, build a UI. What I'll tell most people, if you build a custodian, this is like just a wild guesstimate, but it's a collection of thousands of features. So it is by far like multiple orders of magnitude harder, more complex, and more surface area than any technology that exists in our industry. It is just insanely difficult, like the point where I remember Omani Carson, he reached out to me. Then he was Ron Carson when he heard I was doing this, and he was like, I just wanted to talk to you because when I heard someone was starting custody, I was like, this guy must be batshit crazy. Like he must be losing out of his mind. Who would build a custodian? And then I convinced him to invest, but I think looking back in hindsight, it is really hard. So we couldn't build all 2,000 or whatever it is features. We had to start with a subset and say, let's find a very small SAM of this bigger TAM, the total addressable market. We'll find a serviceable market of a super small percentage. Let's say at the time the market was 5 trillion in assets. Let's target like the bottom 500 billion or something that nobody cares and wants. Like these are the advisors that Schwab doesn't want. Fidelity, nobody wants these advisors. They're probably sub 50 million. And just start there and build something to get these people excited. And then we'll build more and more and more features, right? So that was kind of how we launched the product. It took off incredibly fast. And then we had to really push ourselves to build out the feature set to go up market because bigger firms were coming in. Our inbound was sort of like, I think it'd never been done before, like in this space where we had, I mean, almost every major firm in the country was inbounding, like trying to get an introduction to me to see if they could use our platform. And we have to tell them, yeah, we don't support 90% of what you guys do, but give us a year or two or three. And so here we are, 6 years later, raised a ton of money, built a huge team. We're probably close to like 90%, but we're still not there. Like we still have another, I don't know, dozen critical features and hundreds of kind of minor features to address the totality of the market. And in doing so, we had to build our own self-clearing engine, convert off Apex to Ultras clearing, like tons of other innovations along the way. But yeah, building a custodian is a great way to age 20 years in 5, is how I would kind of describe it.
Indeed, it is. All right, we're just about out of time. That went really fast, but I wanted to touch on a couple things before we go. Can you talk about for current altruist clients or maybe people who are thinking about altruist, what are some features you're looking at building out in 2025?
I mean, there's a few that I'd say are kind of like, table stakes. Like we haven't launched margin yet. Margin's one of our biggest kind of features that we'll launch. When you launch margin, that also unlocks the ability to trade options. So there'll be a few of those kind of table stakes things, but expands that full feature set. Building tons around automation. We've been building, really kind of thinking about our data architecture and our data pipeline for a few years now. And, thinking about how we can leverage essentially a really modern, really elegant, highly searchable data architecture to power AI tools for advisors. So my working thesis today is like the first two tools that I think can add a ton of value to advisors are things that will, some are already invented, right? Like AI note taking and meeting summaries, but that's a huge value add for most advisors. I think email is another one where it's like, if you could wake up in the morning and all of your emails already had a draft response that was based on how you normally write and
Mhm.
the proprietary data that exists inside of your firm and and with all your custodial data and all your unstructured data, like that could be incredibly helpful. So we're going to look at, I think, a lot of the things that can be done to just give advisors more time back, create more automation, more scale so they can serve more people, and get rid of the need for lots more point solutions. Like I think platform businesses kind of should be a lot more open, and your data should be yours, and you should be able to do it whatever you want. And we're trying to work hard to make that possible.
Jason, you've said it all, and we're out of time. So, where can people listening find more information about altruist?
Well, fortunately, every now and again we get mentioned on Ezra Group. So always listen to all of Craig's
Yes.
episodes. Occasionally we get mentioned. I get the alerts on it, so I always appreciate those shout outs. But
Mhm.
altruist.com is the easiest place to find us. Our handle on most social platforms is just at altruist, and then mine's at Jason Wank. If you want to find me, like most founders, I'm very proud of the team, very proud of the work that they're doing, and share all the updates. So it's always delighted to do that. And I'm a bit more reclusive, but occasionally I'll be out and about at events. And so obviously, if I'm there, don't be a stranger. Come by and say hi.
Yeah, you're kind of turning into Howard Hughes lately.
No,
It's hard to
listen, if
find
I
you.
had like super long fingernails and like a bowl of food in my floor of my office, then be worried and send help. But no, we have a lot to do, and it's all worthwhile. It's for the outcome of serving advisors is pretty remarkable. So yeah, we stay pretty hell bent focused on doing that, and subsequently, you might see a beautiful day out there behind me, Craig, but I'll probably be in here grinding at the keyboard.
Keep grinding, man. Thanks for being here. Really appreciate it.
Thanks for having me.
Hey, it's Craig again. Here are my top three takeaways from this episode. Robinhood trade PMR deal analysis. Jason had a lot to say about that. Jason doesn't think the deal will mean much for 1 to 2 years, pending regulatory approval and integrations. He said Robinhood lacks RIA custody capabilities, such as trust accounts integrations. It'll take years to build that out. Advisor economics are very different from Robinhood's retail model. There are brand perception challenges with advisors, and he estimated 10 to 30% of trade PMR advisors may not convert to the new custodial platform. Two, Altruist's growth strategy. We spoke about that. They built on Apex initially to do a proof of concept, and then they developed their own clearing technology. They're targeting underserved small advisors initially, then expanding features over time. And Jason now believes they're at 90% feature parity with major custodians. Looking at the 2025 roadmap, they're launching margin trading and option trading. They're building out AI tools for advisors, and they're focusing on automation and giving advisors more time back. All right, that's a wrap for this episode of the WealthTech Today podcast. Thanks for listening. But before you go, please head to our website, ezragroup.com, scroll to the bottom of the homepage, and sign up for our newsletter. Once a month, you receive an email chock full of wealth management goodness, news, information, and updates. You will not be disappointed. Thanks again for listening, and talk to you all again next time.